presentation contains current opinions of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for December the 18th, 2023. I'm Mo Ansari, President of Compak Asset Management, and don't forget to go to the YouTube page, the compak.com/media page, where you can get the subscribe to this YouTube update, listen to the weekly podcast, download the Market Wrap app, register for upcoming events, subscribe to our YouTube podcast, get the one-pager that I write every week just to keep you updated what's important, what's on my mind, and that's just a one-pager. You can subscribe to that. All of that is free, and obviously you can always subscribe or call us and schedule a meeting with us. All of that is free. All you have to do is go to compak.com/media. Looking at the week, S&P was up 2.53%. For the quarter, we're up nearly 10.5%. Year-to-date, nearly 25%. Dow Jones was up 2.93, but the big star, remember in the podcast, I said my favorite number one pick for 2024. What is it? Well, it's on the podcast, and it was the Russell 2000. It was up 5.6%, more than twice the S&P. I believe this is a seasonal strong time frame for the small caps also. But I think for 2024, we are going to see the small caps as the number one sector. I'm going to reveal the number two sector that I feel is going to be the best one for 2024. That's in the podcast, so tune into the podcast and you will get the number two. I said number one last week, number two this week. We're going to talk about that in the podcast. Real estate, definitely the biggest beneficiary of the lower interest rates, 5.6% for the week. Materials, number two. Industrials, number three. Financials. And technology is way down here. So I think we're seeing, as I mentioned last week on the podcast, that we are going to see a broadening out of the market, and that's what we're seeing. Real estate and materials and industrials and financials are gaining because of the interest rate and what Powell said last week, where he said there will be 3 interest rate cuts, which was a little bit of a surprise for the market. Everybody was saying, well, he's going to say higher for longer. We're still fighting inflation, but inflation is dead. It's going to continue to come down as the shelter continues to come down, which is one of the largest components of the CPI. So I think now we'll have to focus on the economy. We are going to get the economy is expected to slow in the first half of 2024. The question is how much? Do we go into a severe pullback by consumers, which we have not seen yet? We got retail sales, which are better than expected. So I think we're going to see a slowdown, but not a recession. That would be a Goldilocks or soft landing. If we see the market, consumers close their wallets, then we could see some deeper cuts in the GDP numbers, consequently a recession, which I don't think over the last 2 years I've said no recession. Now the probability of a recession going up slightly, but not a lot. I still think it's about 25 to 30%, up from the 10% that I've talked about over the last couple of years. I think the economy is going to continue to muddle along. Looking at interest rates, yield on the 1 week yield, corporates aggregates 4.64, munis are down to 2.8, 10-year below the 4% mark, down to 3.1%. Down from 4.23 last week. So we broke the 200-day moving average on the daily charts. That was the moving average for the yield, just right around 4%, 4.03 to be exact. We've gapped below that, which could be a breakout to the downside. Now the Fed is going to, I think, normalize rates. We've seen the real rates really high. They have a chance of bringing rates down a little bit. So the real rate is not that far above the rates. So I think the market has done a lot of the job for the Fed, and we'll see how the data comes in. Oil down to $71, 71.5, down from 80 where it was last year. Everybody last year was running around saying oil prices, nobody's going to buy a tank of gas and so on and so forth. But we are seeing the prices of oil come down. I think we're going to get a bounce in oil. We've come down a lot. but still the trend is lower. The weekly chart, laggers play up, catch up this month. You can see the small caps up 11.2%, while the S&P was only up 5%. So the small cap was up more than twice the S&P. I think this is a trend that we are going to see continue into 2024. The weekly, we got the CPI last week up 3.1%, year over year 4.0%. Headline PPI 0.9, year over year 2%. Initial claims came down a little. We get the final estimate on the GDP. We get light vehicle sales. We get a lot of data on housing this week, which should be interesting to see. And then we get the PCE, the Personal Consumption Expenditures Index, as it's called. That's inflation number that the Fed looks at very carefully. We get that. We'll see how that is going to work out. Looking at the technicals, the market is up. Went through my 46.84 to 47.32 resistance area. That was the Fibonacci projection from this high that we had made in July. Now we've gone through it. We are today trading at 47.46. Next target 48.18 to 49.23. 48.18 is the all-time high for the S&P. That's where I think we're headed. I didn't think we would get there by the end of the year. But with the Fed saying finally that they're done raising interest rates, they're going to cut interest rates, the market has to reprice itself, and that's what we're seeing right now. Also, the weekly charts, 48.18, the all-time high, beginning of last year. It's been 2 years since we made a new all-time high, so we're headed towards that. But the projection from here to here is 5,000 to 5,051. This is each one of these vertical lines that you see right here, 1 week of trading, going back all the way to 2020 or 2019. You can see that the market after COVID rallied. Then we made a high last year at the beginning, came down, corrected, and now we've sort of been in this range right here. And if we can break out of this range, 5,000 to 5150. Next year, I think it's the first 5 days of the January. That's how goes January, and how goes January goes the rest of the year. So we have to watch what happens in January. A lot of the fund managers, over 60%, are lagging the S&P, especially the large cap. So they have to play catch up. We might see some of them finally coming into the market and start to buy. NASDAQ also broke out. Now the target from here comes to 15.5 to 15.675. That's the Fibonacci projection. Now we've broken out above the 14.4. We're nearly pushing 15,000 this morning. We are at 14,929. Looks like we could be headed even a little bit higher. Weekly technicals, resistance target was 14.8 to 15. We are right in this fifth wave. If we can get above 15,000 decisively, then we are headed to the all-time highs. That would be right here, 16,202, from the high that we made in 2021. We didn't make a high in 2022. S&P did, but the NASDAQ did it in 2021, a couple of months before the S&P did. Looking at the interest rates, we gap below here, the 200-day moving average. You can see this little opening right here, and that's a gap on the charts. We've made this down move. Could get a bounce back up in rates. Today, Ashton Goldsby, who's the head of the Chicago Fed, came out and said the market reacted a little bit differently than what he thought. We're not looking at cutting interest rates. I think the Fed is going to walk back, and we're going to see some hawkish comments from some of the Fed governors trying to curtail this rally that we're seeing in the market right now. Oil prices all the way down and now we're getting the fourth wave bounce, wave 1, 2, 3. Now we get a fourth wave bounce, and that's what we're seeing right here. We touched the 20-day moving average today. The 200-day is 77.76. We could get a bounce and then another decline in this market. Gold market got up to 2150, pulled back all the way, fourth wave, wave 1, 2, 3, 4, and then we start for the fifth wave to the upside. But we've used a lot of this energy to the downside, a lot more than what we expected. So getting above 2150 is going to be difficult for the market, but that's what we're looking at. Those are my views. Those are my thoughts for December the 18th. I will be gone for the next couple of weeks. Next is Christmas next week, on next Monday, day after, and then we've got the New Year's the day after, the week after that. So next couple of weeks, there will be no updates. So this will be the last one of the year. I hope you have a wonderful Christmas. Have a safe and happy New Year. I'm looking forward to it. I will get into more detail on the podcast. Javed and I will. We'll talk about it and get into more detail what we're looking at. And I will reveal my second best sector. The first one I revealed last week. This week, I'm going to reveal the second best sector for 2024. So tune in. It's much more detail. We'll talk about the market. We'll talk about what we're looking for 2024. Have a wonderful Merry Christmas and a Happy New Year.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.